Welcome back to the channel, everyone. Today I want to talk about Robinhood's massive loss. I also want to go through another FUD article and talk about AMC signing a new deal for 2 massive theatres. Trust me guys, you do not want to miss this video. So stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 1,800 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell if you haven't already, so that you don't miss another video just like this one. And now I want to dive straight in with the key information. So, Robinhood reveals rising revenue and a $1.4 billion loss. The stock trading app unveiled its initial public offering prospectus on Thursday, pulling back the curtain on its financial performance for the first time. Robinhood, the stock trading app that grew in popularity and notoriety during the pandemic, revealed skyrocketing revenue and a loss of more than $1.4 billion in the first 3 months of this year, as they took a key step on Thursday towards one of the year's most anticipated IPOs. Robinhood made the disclosure in an offering prospectus a day after saying it would pay a $70 million fine, the largest ever fine imposed by the Financial Industry Regulation Authority, or FINRA, for misleading customers and harming them with outages. Just a quick one, I personally don't think this $70 million fine is anywhere near enough. They made well over $400 million last year by accepting payment for order flow from Citadel and potentially caused billions of dollars in losses to retail investors like you and I on AMC and GameStop. That's thousands and thousands, potentially tens of thousands or hundreds of thousands of people that could have lost their entire life savings because of these Robinhood outages, and all they get is a $70 million fine. Its offering, heading into an ebullient and unpredictable stock market, will test whether investors will continue to embrace fast-growing tech startups that arrive on Wall Street with uneven profits and plenty of baggage. In January, Robinhood became the latest in a line of Silicon Valley companies to gain national attention for less than ideal reasons, when it restricted some trading after a swarm of investors swelled to the values of so-called meme stocks like GameStop, the video game retailer. The move, which Robinhood said it had to make to meet capital requirements, outraged many users, drew nearly 50 lawsuits, and led to protests outside the company's headquarters in Menlo Park, California. Its executives were summoned by Congress for a tongue lashing at a hearing a month later. Revenue was $420 million in the first 3 months of the year, a greater than 4-fold jump from $96 million a year earlier. It lost $1.4 billion during that period, far wider than a loss of $53 million a year ago. The company attributed the loss to $3.5 billion in debt that it raised in February. We know that Robinhood raised tons and tons of money to meet cash requirements during that January and February period, but they actually paid massive transaction fees to raise those $3.5 billion. I personally don't think that Robinhood have learnt from their mistake, especially as they continue to sell their order flow to market makers like Citadel. It's a very corrupt practice, selling the order flow in the first place, especially as Citadel then just pass all of that order flow through a dark pool and don't let those orders impact on the lit exchange price. Really, if you haven't already, you should be using Fidelity or transferring your shares out of Robinhood into Fidelity and making sure that your orders are routed directly to the New York Stock Exchange, as opposed to going through a broker that engages in payment for order flow and sells that order flow to Citadel. If you haven't yet moved and you're wondering how to do it, I'm sure someone will leave a comment below explaining how it's done. Alternatively, on a lot of my other videos, people have asked the same question and have received similar help. So what about that FUD article that I wanted to talk about from Seeking Alpha? AMC, the hype is fading, don't buy the dip. Firstly, we know the hype is not fading because AMC is still the #1 most talked about stock on Wall Street Bets and has been for a number of weeks now. We also know that the stock price is just being manipulated by market makers like Citadel, passing all of that payment for order flow transactions through the dark pool so that it doesn't impact on the lit exchange stock price. They're then passing all the sell orders through the lit exchange so that it crushes the stock price, but the buy orders aren't reflected. Supposedly, AMC is cashed up, but the stock is now more vulnerable than ever. Although they then subsequently contradict themselves by saying that AMC's got more than a 1,500% return year to date under its belt. And also talks about AMC setting new records as US theatres were visited by 2.5 million people during the previous weekend, while theatres in Europe and the Middle East had had more than 650,000 visitors. This is yet again another post-pandemic attendance record for AMC with 3.2 million visitors over one weekend. It then also says the revenue estimates imply that AMC is expected to return to pre-pandemic glory in Q4 of 2022. Therefore, this article even proves that short sellers have the wrong idea, because AMC is expected to make a bounce back over the next year. The article even then goes on to talk about how AMC only recorded cumulative losses last year and a negative cash outflow due to high capital investment in new theatres and screens. As AMC has now raised tons and tons of cash, they can pay off a significant portion of that debt and therefore won't incur that high interest cost and therefore won't be making a loss going forward over the next few years. The article even then suggests that bankruptcy is not a probable outcome, and therefore shorts clearly have the wrong idea. Shorts are trying to short AMC into bankruptcy, but even Seeking Alpha agrees that bankruptcy is not a probable outcome. I personally think that even though this is a FUD article, it should help secure your bull case thesis for AMC. Yes, the AMC short squeeze is a short-term element, but at least this just proves that the shorts have the wrong idea. As more and more shorts actually realise that they have the wrong idea and AMC is not going bankrupt, they'll start covering their short positions as they see more and more losses on their trades. The AMC ape army will also continue to hold strong and will be buying up any shares they can possibly get their hands on, only making it more and more difficult for those funds to get their hands on actual legit shares. When they do start deciding to give up on their short positions because they see that AMC is turning profitable and need to cover, they'll have to push the price up and pick up our shares, buy our shares at any price we want to sell them to. Considering that we, the apes, own the float, we set the price. So let's also talk about AMC signing a new deal to lease the Grove and Americana, two of Los Angeles' top grossing cinemas. Both locations were formerly operated by Pacific Theatres, and AMC is expected to reopen these theatres in August. Adam Aron himself said it's a great pleasure to announce two long-term theatre leases on the Grove and the Americana, gorgeous theatres as our newest AMCs. These are no ordinary theatres. In 2018, they were the second and fifth highest grossing movie theatres in Greater LA, hoping to add several more theatres as well. Clearly, Adam Aron has a very aggressive acquisition strategy for new theatres, as well as paying down that debt will leave AMC in a great spot. AMC's collected more than $1.6 billion in cash from stock sales and had previously disclosed that it was looking at several of Decurion's old leases, looking for locations that had strong ticket sales before the pandemic. These two theatres each are located in world-class lifestyle centres, offering the best in retail, dining and entertainment options, AMC CEO Adam Aron said in a statement on Monday. Each was conceived and run by Caruso, one of the largest and most admired privately held real estate companies in the United States. AMC has just been announcing more and more good news, and yet the AMC stock price continues to fall, clearly showing that it's currently being manipulated by those shorts. If anything, you'd currently be expecting more and more funds to be buying shares in AMC because of how great their recovery is currently going. AMC is very successfully starting to escape that risk of bankruptcy, and therefore that bear case of shorting the stock makes no sense anymore. Also, be sure to let me know down in the comments below what you think about Robinhood taking this massive loss and AMC opening these new theatre locations. If you haven't already, I'd really consider checking out the link to the Patreon and the private Discord down in the description below and becoming part of the team where we discuss AMC and other stocks, talking about due diligence, news updates and more. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.